Is more downside for Fairfax today.
When you see such a big seller of a 5% stake in Fairfax, it usually puts downward pressure on the share price. Now, the share price has been falling quite dramatically. Only a month ago, we saw Gina Rinehart selling a 5% stake at 58 cents, now trying to offload another 5% at 50 cents. And of course, the shares yesterday are finishing up around that 51-cent mark. So altogether, it looks like more disappointment in store for Fairfax, and it does come after quite a big loss yesterday, where we saw a loss of $2.7 billion. Most of that on the back of write-downs, and we did see the assets, it has dropped from $4.4 billion down to $2 billion, mainly on the back of write-downs to its key mastheads like the Sydney Morning Herald, The Age, as well as the Fin Review. So altogether, Fairfax shareholders have been in for a rocky ride, and I have had a rocky ride, and I guess they're in for a bit more. And this comes as calls become a lot louder for the company to perhaps look at a piecemeal breakup of their business because of what the market is attributing to these values at the moment. So it does look like those reports that Gina Rinehart is looking to offload another 5%, to drop a stake down from 15% down to 10%, may put some added pressure on the shares today.
Julia, we always hate to put you on the spot, but we do it so often. Just some breaking news. Whitehaven Coal saying that Nathan Tinkler, or his group at least, has dropped its takeover proposal for the company. We are expecting profit numbers out from them today. And last we heard, Tinkler asked for more time to conduct due diligence on the coal miner. Just your take on that development?
I guess that would add some weakness to Whitehaven Coal's share price, and there has been a lot of speculation that perhaps Nathan Tinkler wouldn't be able to get the funding he needs for that privatisation and that takeover of Whitehaven Coal. So unfortunately, it does look like it is a difficult area to get funding in at the moment, especially with commodity prices sliding, and a lot of that has to do with the subdued growth coming from China. If we have a look at the key uses of coal as well as iron ore, it's in steel making, and if we have a look at what steel is useful, well, this is driven by construction and the urbanization of China, and we know that China slowed down in terms of the building market and the property space there. So I guess another negative for that material space, especially given that we did see the first read on manufacturing for China for the month of August. Well, we saw the flash PMI numbers, and they were the lowest that we've seen in about 9 months, coming in at 47.8. So altogether, not wholly unexpected by the market, and I guess that's been reflected in Whitehaven's share price, but I guess formally coming out to knock, that bid's no longer on the table.
Yeah, absolutely. It sounds like a weak coal price partly behind that decision, potentially. NWH Holdings out with numbers today. Julia, you've run your ruler across those ones?
An absolutely fantastic result. It's been a record year for NWH. In fact, if we have a look at some of these numbers, they are quite incredible. We saw net profit rising an amazing 136%, coming in at $97 million. Now, we were expecting to see a profit of $93 million, so coming in ahead of our expectations. Revenue growth of 82%, coming in at just over $1.3 billion, and we saw EBIT growth of 158%. So altogether, some very strong numbers coming through. Now, if we have a look at NWH and what it does, this is a civil engineering group and contract mining group, and of course a lot of the demand has been driven by out of WA, especially the iron ore miners. But if we have a look at NWH, they've also been trying to expand into the oil and gas space in WA, as well as the Queensland coal space. It does look like the outlook looking quite strong. Their order book is at $2 billion at the moment. In terms of the current financial year, FY13, they already have $1.3 billion worth of revenue secured, and they've got tenders open for about $4.6 billion as well. So it does look like the pipeline quite strong there, coming out with a good set of results in their order book, and the potential revenue for FY13 looking quite strong as well.
And just finally, Julia, Woolworths reporting today. We spoke to Ben Lebrun earlier, and he suggested we might see a bit of a move back in terms of sales growth towards Woolworths after Coles' strong run-up. What do you think?
If we have a look at Woolies, we've seen the share price up about 10% over the last 3 months, but then we compare it to Wesfarmers, which of course owns Coles, it's up by 15%. And in terms of Woolworths results, no huge surprises are expected here. Their own guidance was for net profit growth of between 2 to 6%, and that's really what we're expecting. We're expecting to see around about 3% growth in net profit to come around about 3% growth, so about the middle of the range there. And if we have a look at some of the things that the market's going to be watching for, we know that they're trying to sell their Dick Smith electronics business, so I'll be watching for that. The food and liquor business, of course, is very important. We're making up about 76% of Woolworths' earnings, and FY13 guidance, it stands at about 8% growth at the moment. That's the consensus by the market. So the market's going to be watching that one closely, and that's probably the key to the share price reaction in Woolie's result today.
Okay, and just in terms of opening calls for the market, it looks like we're headed in the wrong direction today. Julia, how do you think the session will pan out?
It's actually been a pretty good week so far for the Australian share market. In fact, we were on track for the 6th consecutive week of gains, which would have been the longest stretch that we've seen since the February-April period in 2010, where we saw a 10-week gain there. But it does look like that may be derailed today, given the action that we've seen in overnight markets. We did see Wall Street having its biggest fall since July, with the S&P 500 index down by 0.9%. And we saw the material sector being the worst hit there, so no surprises there, given those numbers that we saw out of China yesterday. So the Australian market does look like it's going to give back some ground. Woolworths is the biggest earnings release which comes out to the market today, so we'll be watching that one quite closely. But all in all, this week's been dominated by two things, and that's earnings and then dividends as well. And if we have a look at the performance sector by sector, the worst sector has been the telecom sector, and that's of course being driven by Telstra going ex-dividend. We've also seen the energy sector coming under pressure, but on the flip side, healthcare doing extremely well today on the back of CSL's performance, which has risen 4.6% for the week. So all in all, we were hoping to see the 6th consecutive week of gains, but really it does look like that may be derailed with some softer leads from offshore.